Thursday, February 8th, 2024, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at the technical picture for the stock market, very long term, and you will see why. But I think the possibility of a major melt up is there. And I'm going to show you why I think the GreenSpan put has not gone away. It's still alive and kicking. So, yeah, before I do, you might be asking yourself, what are you wearing, Mario? Well, it's my Walden Enslavement Forum hoodie. And if you're interested in getting one, there's a link below in the description where you can go to Wide Awake Clothing. They have great themes on that website. I highly recommend it. I've ordered some more, and hopefully I'll be wearing it to make a point, to try to wake people up. So back to the GreenSpan put, back to the melt up. Well, we're going to go right to the charts. And you probably haven't seen this chart before, or maybe you have, but I doubt it. This is a 124-year chart of the Dow Jones Industrial Average. It doesn't look like it's melting up, does it? Because I've put it, I set it to a logarithmic basis, which measures the prices on a percentage terms, not in a geometric term. So it's a little more indicative of what's really happening on a percentage basis. And the reason I've taken the Dow Industrial Average is that it's been around the longest. It's been around since before 1900. This chart, though, as you can see here, it starts in the first quarter of 1900. So it's exactly 124 years old. So why do I think we've got a melt up almost on our hands? Well, the top here is, as you can see, third quarter of 1929. We know what happened in the 1920s. That was the roaring 20s there. So I think, yeah, we went from around 65 on the Dow all the way up to almost 400. So it was a big move. And then we dropped all the way in 1932 to around 40. So it's a massive percentage drop, as you can see here. It's the biggest drop on this chart. It actually is not a blip like we see going forward. A lot of the corrections and crashes we've seen in the last few years look like a blip on this chart. But let's start with the green line first, because this is where the GreenSpan put comes in, I think. And this is speculation, or this is my analysis from it. So we go from the top in 1929. That's a major top, of course, major historic top. And I think it took until, as you can see here, it took, yeah, until 1950. 4 or 55 for the market to recover back to the old high. So it took over a couple of decades, as you can see. It hasn't been as bad as Japan. The Nikkei hasn't retraced back to 39,000, which was the high in 1989, which is more than 3 decades. But anyway, so yeah, we broke through that in the mid 50s or thereabouts, and then we made new highs, and then we plateaued from the late 60s until the early 80s. That was the stagflation environment of the 70s, and then started moving up. And this is where it gets interesting here. And I'm going to move this here because I can't see anyway. So when we get here, this is around, we break out of this trend line, this first quarter of 1986. I mean, Volcker was still chairman of the Federal Reserve, but yeah, the stock market broke through that line, and that was quite bullish. And it's not a surprise that we saw it move up even quicker uh, up until the third quarter of 1987. And I think we went up to, let's see, 2,700 or thereabouts. And Greenspan had just taken over as chairman of the board of the Federal Reserve. And then we had Black Friday, was it Black Monday, I think, in October of 1987. And the stock market dropped like 20%, the Dow Industrial Average in one day, not in a week, not in a month, in one day. And look at how we broke below that very long-term trend line. And that's when Greenspan, yeah, that's when the Greenspan put was born, and he injected the market with liquidity. He didn't allow the market to just trade naturally or organically. So this is when the Greenspan put was born. And yeah, few couple of years later, we are making new highs again. And Greenspan, as we know, he kept yeah, he kept using the put, and the markets got used to it. It's like an addict getting used to his drug dealer always being there for him and actually giving him his drugs for free, almost or practically. And of course, this was the '08 crisis. That was a fairly big drop. I would say it's the second biggest drop. Well, after the 1929 crash and the rest of the crash that actually bottomed in 1932, this was the biggest, second biggest after that one. And you can see now that this new trend line, and this is the top from the dot-com bubble. And again, Greenspan, don't forget, when we had the dot-com bubble burst, he cut rates down to 1, if I'm not mistaken, and then engineered the housing bubble as well. And here as well, Greenspan was not around at this time anymore. It was his sidekick, Bernanke, the man who was the pioneer, so to speak, of money printing, or QE, who even wrote in 2002 that the United States has this, the government has this technology where they can just, for no cost, really just print money and save everything. So, yeah, this is where they opened the floodgates with massive QE, zero rates for over a decade. They took the balance sheet from 800 billion, the Fed's balance sheet in assets, to almost 9 trillion up until a couple of years ago. And I've spoken about this chart before a few years ago. And this is the 2020 crash. It looks like a blip on this chart, and that's because this is a logarithmic chart. And it's scary because if we really see a major crash like 1929, it's not going to be from where we are now, almost at 39,000 to like 30,000. No, because if you look at here, it won't really be much of a correction. It will be, let's use the word again, biblical. Okay, that's what it will be, and this is probably why I think I've heard people like Charles Nenner use the 5,000 level in the Dow. Maybe he's looked at this chart. Who knows? But and this is the reason why I'm saying here, and I'm going to enlarge this for you. It looks like we are in melt-up territory. We were in melt-up territory here as well, and this was just, when was this? Yeah, this was just after the, I think in second quarter of 2021, we were in melt-up territory. It wasn't just consumer prices that started rising too quickly. It was also the stock market. Very interesting times. Some of you might know that Greenspan, of course, was also a gold bug. He wrote in 1966 about gold and economic freedom. He stated that statists, fascists, corporatists hate gold because it promotes human freedom, economic freedom, because the general public has control of their money. And he was a disciple of Ayn Rand, the objectivist, who did not believe in big government. He believed in the individual, but he kind of sold himself to the devil, so to speak. He joined the wrong crowd. He and To show you that, I'm going to reference his book, Alan Greenspan, The Age of Turbulence. And if we go to page 81, this is what he says here. And he's talking about the private citizen. Even so, I did build up a wonderful circle of friends. Barbara threw me a 50th birthday party at her house. The guests were the people I'd come to think of as my New York friends. Henry and Nancy Kissinger, Oscar and Annette de la Renta, Felix and Liz Rohatyn, Brooke Astor, I knew her as a kid of 75, Joe and Esther Lauder, Henry and Louise Grunwald, Carol Sulzberger, and wait for this one, David Rockefeller. I'm still friends with many of these people today, more than 30 years later. So he went over to the globalist, corporatist, bankster crowd. And unfortunately, that's what Greenspan did. So how does gold look in this situation? Well, I think gold might be telling us, and we'll go to look at a chart of gold now. Let me just bring it up here for you. And we're going to look at the very long-term chart here. And we're going to look at it as well in a logarithmic basis. So here we go. Many of you, here we go. There's gold. Many of you have heard of what's called a cup and handle formation. Well, it's a very bullish formation, and we had one here back in the early 2000s. It was built from here, and we broke out of that. This is the cup. This is the handle. It's called a teacup or cup and handle. Top of the cup. We broke out of this here, and then we kept going up from 400 all the way. Well, you could argue all the way up to almost 2000. So right now we're building another cup and handle, and we're almost breaking out. So to me, it shows that the Fed might keep that Greenspan going, and we could see a melt up in the stock market. We could see gold go through the roof faster than the stock market goes up. And that's normal because a melt up is basically the loss of confidence in the dollar, really. This chart of the Dow doesn't indicate that the economy is doing well. It just indicates there's a lot of debt out there, a lot of currency, a lot of inflation, and people want to go, put their money in anything but dollars. And I think that's what gold is telling us here. And why do I think the melt up is here in terms of fundamentals? Well, I think the investors and traders, hedge fund speculators, they expect this Greenspan put to be implemented again. And that's what the markets is telling us, especially how can they be even talking about rate cuts when the markets are melting up like that? I mean, I know Jay Powell pared back the amount of cuts that the market expects from 6 to 3. But if anything, the Fed should be hiking rates still because the markets are too bubbly. But as Greenspan said, to hell with the bubble. You just have to deal with the consequence of the bubble. That's what he said. Let the bubble inflate. He said, I never saw any bubble. I only saw it when it burst, and then I threw everything at it. So that's where we are. Yeah, not necessarily a good sign, I would say, for it doesn't mean that the economy is doing well. Some years ago, I think 2017 or 18, when Venezuela hyperinflated its currency, the Caracas Stock Exchange was one of the best performing in the world. And I think the Harare exchange as well, some years ago in Zimbabwe, did really well as its currency uh, fell through the floor. So yes. What's the other alternative to a melt up? Well, the other alternative is that the Fed actually does a 180 and says we're going to hike rates. We're not happy with this the speculative aspect of the market, the fact that we're here at all-time highs. We have stocks like Nvidia. We think people have gotten too irrational. We're going to actually raise rates, and we're going to keep raising rates until we squash this speculative spirit. Well, then we could see this 100 and well, actually, yeah, almost 120-year bull market come to an end in the Dow, and we could actually see uh, a real crash back down to 5,000, but I doubt it. What do you think? I mean, this is my opinion. I'm not saying uh, this melt up is going to happen, but it looks like it could. So yeah, comment down in the comment section below and let me know what you think. And with that, I'm going to wish you all a very good rest of the day. Take care. Bye.